Okay, hi everyone, welcome to today's webinar. So today's session will be on mastering the Traders Dynamic Index or TDI Trading Strategy. I'm Melanie and I'll be going through today's topic with you. I can still see a couple of people coming in, so we'll give about maybe 1 more minute to let more people join the session, and then we'll go ahead and get started. There should be some time at the end for us to look at some charts, so if you guys have any requests, feel free to pop them into the chat as well. Thanks, everyone. Okay, let's go ahead and get started. So as per usual, a disclaimer and risk warning. This information is not considered investment advice or investment recommendation, but instead a marketing communication. Risk warning, our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. So I'm Melanie, and I'll be your speaker for today. I'm an investment analyst at Rocket, who are finalists for Best FX and Equity Research in the years 2019 to 2021. Okay, so here's our agenda for today. We'll start off by doing a brief introduction on what exactly TDI is, how it works, and then we'll look at how exactly you can use it as a trading strategy and improving on the strategy. Okay, so let's get started. So what is the TDI or Traders Dynamic Index? So it's a composite indicator that combines three different elements of RSI, moving averages, and Bollinger Bands into one indicator, and it gives traders a clearer picture of market conditions. So it helps you to identify trend strength, momentum, and market volatility in a single glance. So why should you use it? Because firstly, it helps to detect trend reversals earlier. It combines multiple indicators into one tool, and it works across different time frames and market conditions. Okay, so before we get into this, let's break down the TDI components. So it's made of three different elements, as we saw here: the RSI, which measures momentum and overbought or oversold levels; moving averages, which would be your signal line, which I'll show you guys in a bit, which helps to smooth out RSI movements; and lastly, the Bollinger Bands, which show volatility and trend direction. So let's break it down further. So we talked about RSI showing us the strength and volatility of the market, indicates if price is overheated or overbought, smoothened out by moving average. So the TDI consists of three main lines, but we'll talk about the two first. So the two main lines are the green RSI price line, and it tracks shorter term price movement. So that's why we labeled it as the fast line. And then the red line, or your red RSI line, is the signal line. So this smooths out RSI for clearer trend direction. I'll talk a bit about the blue line that I mentioned earlier on in a little bit as well, but that's basically our market baseline, and it shows just the overall market sentiment. Okay, so next, moving on, the Bollinger Bands are used to estimate the oscillation amplitude, which is basically your trading channel. So the key levels to define market reversals are 68, which would be your overbought zone, and 32, which is your oversold zone. Okay, so this is just an example of what the TDI indicator looks like on TradingView. So you can see it's definitely a combination of all three indicators. You can see the Bollinger Bands, our RSI, the price line, the green line, and the red line, which is your signal line. So how do we read this? So the crossing of green and red lines basically is a short-term trading signal. Your buy signal occurs when the fast green line crosses above, or rather crosses your signal red line from below. Your sell signal is when your fast green line crosses the signal red line from above. So the cross occurs often, and stronger signals occur if crosses in the overbought or oversold region. Okay, so here's an example. The blue lines are basically, the blue circles are basically where the lines cross over each other. And these are in more prominent zones as well because it's in the oversold zone of the Bollinger Band and the overbought zone in the upper limit of the Bollinger Band as well. Okay, next we have the red and orange lines. So it's a buy signal, and this is more for longer term trading signals. So a buy signal is when your signal red line crosses the orange line from below, and a sell signal is when the signal red line crosses the orange line from above. So here's an example. Okay, so sometimes this line is orange, sometimes it's blue. Okay, so more about the orange line. So this is more of a rarer long-term trading signal. So an orange line crosses the 32, 50, and 68 level. This buy signal occurs when the orange line crosses the level from below, and a sell signal is when it crosses the level from above. So here's another example. Okay, so now let's talk a bit about possible trading strategies. So we've already talked about what are the different indicators that are part of TDI. It uses several classic indicators like your RSI, moving average, and Bollinger Bands. So these are best to use TDI with a trend indicator. So this can be something like your Ichimoku or MACD as well. Support and resistance levels are, your basics that should always be used with any kind of indicator. Stop loss and take profit are just basic risk management tools. Okay, so here's an example. First we have the first support, which is in line with two swing highs here. A second support, which is just placed at this swing low, and a first resistance that's in line with an overlap level. So what an overlap level is when you have a swing low in line with a swing high. Okay. And you can see at this level, or this blue vertical line that we've highlighted, prices when the red line crosses below the green line in the upper limit of your Bollinger Band, then we start to see this downtrend occurring here. And we also see this resistance of the first resistance that we highlighted. Okay, here's another example. So here we have a first resistance that's highlighted um, in line with an overlap again, so swing high and a swing low, and the first support that's in line with a swing low. Okay, here we see the orange line being crossed by the red signal line. Okay, and we see price subsequently shoot upwards. Okay, so let's talk about how to improve on the strategy. So as per usual, a very typical method of ours is to support our indicators with Fibonacci. So here we're using Fibonacci retracement, which is possibly the easiest Fibonacci to master. So we're taking from this, the trend line is from the swing low to the swing high here. And we are expecting prices to continue to drop here. So prices are moving upwards, and we can see where prices react off the 61.8% Fibonacci retracement. In line with this vertical line, you can see on our TDI indicator, the red line crossing below the green line. So that's giving us a bearish signal. Subsequently, we see prices drop to the 61.8 level. Okay, so this is a combination of your support and resistance along with Fibonacci, which is something that we do regularly, and then just with the addition of your TDI as an additional confluence signal. Okay, any questions so far? No? All good? Okay. So this next, let's look at TDI divergence. So this is another popular strategy for TDI. Okay, which time frame is the best? Like I mentioned earlier, this works across multiple time frames. It just really depends on your own trading strategy. So if you're looking at, so let me just go back in my slides. We normally like to trade on the medium time frames, so 4 hour, 1 hour, or even daily time frames. So I think that would work. But depending on your strategy as well, if you look at my slide here, if you're looking at a longer term trading signal, then you should be looking at the red and orange lines. Okay, if you're looking at, like I mentioned, the shorter time frames, then you would be looking at the fast green lane and the red line. So this is more for shorter term, and this works for longer term. So really, it works across multiple time frames. It just depends on what you're looking for. Sure, no worries. Okay, let me move on. We're talking about the TDI divergence. Yes, here. Oh wait, we have another question. How about period for using RSI, Bollinger, and SMA? So, again, it depends on your trading style and time frame. The default, let me, maybe I can pull up my charts now. Okay. So the default for RSI, if I'm not wrong, is 14 period RSI. Bollinger Band is 20 period with a standard deviation of 2. Let me check. Um, RSI and SMA. Okay, yeah. So 20 with a standard deviation of 2. For shorter term trading, you can consider increasing it to a 10, decreasing it to a 10 to 15 period Bollinger Band, because then your bands will be tighter and would be better for quicker trades. If you're looking for swing trading, then you can stick to this 20 period Bollinger Band setting. Longer term, you can consider 50, which would be more useful for looking at major trend shifts. Now let's look at SMA. So these are the default settings, 9 or 10 period. Um, and okay, here is 14, but you can look at 21 period SMA as well. Okay, it just helps to identify micro trends. Yeah, let's look at RSI now. So RSI, yep, the default is 14. Length is about 14 as well. You can change it to 10 to 7 to 14 is fine. For swing trading, you can increase it to like 21 period to filter out the noise. Longer term trading, you can look at 21 to 50. Okay, but if we're looking at TDI settings, some common combinations, we'll just go through them really quickly. So some common combinations can be 13 RSI, Bollinger Bands about 34. Yeah, I like to just keep it to the default actually, but you can change it as well. 13, 34. This is more popular for Forex setups. It's different for swing trading and trend confirmation, so you'll have to probably check on that. Moving average, we can look at 7 and 34. Hmm. Okay. Oh, can you guide us on setting the TDI? Sure. So actually, it's just a standard indicator. So it's already in your trading view. Uh, So you just click on this icon here, the indicators icon, and then you just search up TDI. Um, I think sometimes it'll come up as TDIGM, and it's just this one. And then it'll come out looking like this. So you don't actually have to individually combine all of your indicators. Okay, so let me get back to my slides. So yeah, we were talking about TDI with divergence, which is another very popular TDI strategy. So you basically look for divergence between TDI and price. So if price makes higher highs, but TDI makes lower highs, it signals a potential reversal downward. But if in this case we see price making lower lows, but TDI making higher lows, it signals a potential reversal upward, which is what we kind of see here. So if you guys missed our divergence webinar, I'll just briefly cover a couple of points here. So divergence in trading basically compares the movement of a security's price and an indicator. So in this case, we're looking at price and also our TDI. But this works for RSI and stochastic oscillator as well to identify potential trend changes. So there are two types of divergences, bullish divergence and bearish divergence. So bullish divergence occurs when the security's price makes a lower low, while the indicator makes a higher low. So you can see here, blue represents price, and then the red represents our indicator. So for a bullish divergence, when price makes a lower low, but the indicator makes a higher low, this suggests that the downward momentum of the security is losing strength and a potential upward trend may emerge. A bearish divergence, if we look on the left, occurs when the security's price makes a higher high while the indicator makes a lower high over here. So this suggests that the upward momentum of the security is losing strength and a potential downtrend may emerge. Okay, so we can look at our first bearish divergence example. So the reason why this works for TDI as well, this normally works for RSI and stochastic because they are momentum oscillators. So because our TDI also takes into account certain components of our RSI indicator, so this method works well for that as well. So anyway, for our first example, this is a bearish divergence. We have price testing this key horizontal resistance level. With price making a smaller high, resulting in a bearish divergence with our RSI. You can see it's making a very slight, there is a slight decrease over here. So it's not a straight line, even though it kind of looks like it on first glance, it is sloping downwards slightly. So our descending resistance line on RSI caught the past two reversals correctly, and it forecasts that we could be seeing a reversal here. Okay, so subsequently, this is what happened. Price reverses strongly because of horizontal resistance, RSI resistance, plus bearish divergence. And we can see RSI has also reversed very strongly here. Okay, point number two. This is a very simple example of bearish divergence. We have prices making a higher high, and on our stochastic, price is making a lower high. Okay, and subsequently we see price dropping. Now that same pattern repeats itself further down, with price making a higher high, stochastic giving us a lower high. This repeated pattern plus a hidden resistance level suggests that we might see prices continue to drop, and that's exactly what happened here. Okay, so now let's bring that into our TDI. Okay, so here we have prices making a higher high, TDI making a lower high, which is a bearish divergence. Secondly, you also have the red signal line crossing below the green line, which is also a bearish signal. Okay, so both of those. Additionally, we have we have TDI showing us that this reversal happens in the overbought regions of the, I guess, the Bollinger Band component of TDI. So this also suggests a potential reversal, which we do see happen after that. Okay, another example with using Ichimoku Cloud. So earlier I did mention that TDI, because we are using different kinds of indicators, if you want to combine it with an additional indicator, it should be something that it's not currently measuring. So something like a trend indicator will work better. So an Ichimoku cloud shows us a trend perfectly and at one glance. So here we have price moving below the Ichimoku cloud, which of course is a bearish signal. So let's start with the first crossover where our red line crosses below the green line. So that happens when price starts to cross below the Ichimoku cloud, giving us a bearish signal. Okay, so we can see that crossover slightly. Subsequently, we see prices drop below significantly, and also take note this happened in the overbought regions. And the second time this happened when price rose up slightly to hit the Ichimoku cloud again. The red line crossed below your green line, giving us a bearish signal. And again, this happens in the upper limit of your Bollinger Band component. And we see prices also moving below that Ichimoku cloud. So it gives us a overall bearish signal. Okay, any questions? Mm. So next, because last week, there were a couple of you guys who requested me to go through Ichimoku Cloud. So I thought this would be a good time to kind of link that together with TDI. Um, I won't go too in depth with Ichimoku because we have gone through it in recent weeks, I think. But I will just briefly cover what exactly it's about. Okay, how to define long-term and short-term time frames. So it basically depends on your trading style. So for short-term time frames, before I get into this. So before you get um before we talk about Ichimoku, let me just answer this question. For short-term time frames, it's used for mostly scalping, day trading, and intraday strategies. So your time horizon ranges from a few seconds to a couple of days. So your time frame, you can look at maybe 15 minutes to an hour for intraday. We normally wouldn't recommend you going below 15 minutes because then charts get a little bit noisier, it's a bit harder to analyze. Um, and 4 hours then is kind of the start of your swing trading time frame. So it's more short-term swing trading. And these are basically trades that can last for a few days. For longer term time frames, your daily time frame is one, and that's for you used for swing trading trades that can last from days to weeks. Also, position trading, which would be your weekly time frame. Um, Monthly time frame we normally don't really look at because those take longer for you to actually see results, but that's more for longer term investing. So if your trades are lasting from a couple of months to years, then you can look at monthly as well. Yeah, so a quick way, I guess, to answer your question, how to define it, how to define long and short term time frames. Um, I guess if your trade lasts from a few minutes to a few hours, it's short term. If your trade lasts from a few days to months, then it's long term. That would be the easiest way to define it, I think. Okay, I hope that answered your question. So next, let's quickly go through a bit about Ichimoku. So there are a couple of different lines when it comes to Ichimoku. We have Tenkan Sen, which is the conversion line, Kijun Sen, which is your standard line, Chico span, which is the lagging line, and the cloud, which is the one that we use most often. So the first way to use Ichimoku is to help you to identify trends. First, we have the Tenkan-sen, which is your blue line, and the Kijun-sen, which is the red line. And these are used to identify the trend of the market. So a bullish trend occurs when the Tenkan-sen is above the Kijun-sen, and a bearish trend occurs when the Tenkan-sen is below the Kijun-sen. Okay, so here's support and resistance. You can also use the Senko span A and B for your support and resistance levels. So, if the price is above your Senko span A and B, it's considered a bullish market. And the Senko span A and B can also act as your support levels. If price is below Senko span A and B, it's considered a bearish market, and A and B can act as resistance levels. Okay, so let's talk a bit about the lines. So we have the leading span A and leading span B. These basically outline the cloud, which is arguably the most important factor of your Ichimoku. Okay, so the Chico span is used to confirm the signals generated by the two lines that we talked about earlier and the Senko span A and B. So if the Chico span is above the current price, then it confirms a bullish trend. And if the Chico span is below current price, it confirms a bearish trend. Okay, so Ichimoku generates buy and sell signals based on the positions of the various components. For example, a buy signal is generated when the Tenkan-sen crosses above the Kijun-sen, and a sell signal is generated when the Tenkan-sen crosses below the Kijun-sen. Okay, and these are the inputs for Ichimoku. Okay, so the most effective way to use Ichimoku, I've gone through all of the different ways that you can use it, um, based on looking at the different lines, but the most effective and the way that we normally use it is by simply looking at where price is in relation to the cloud. So the overall trend is up when price is above the cloud, and it's down when price is below the cloud. And it's trendless or transitioning when price is within the cloud. Okay, so that's, I think, a lot easier to use than if you had to memorize all of these lines and figuring out whether it's above or below, so on and so forth. Okay, so traders will often use Ichimoku Cloud as an area of support and resistance depending on the relative location of the price. The cloud provides support and resistance levels that can be projected into the future. So this sets Ichimoku Cloud apart from many other technical indicators that only provide support and resistance levels for the current date and time. Okay, so here's an example of how you simply just look at the cloud. So you can see praise moving below the cloud is a bearish signal. Once it moves within the cloud, you can tell that praise is kind of transitioning, or it's in a trendless movement. Once it breaks out or bounces off the cloud, then it's in a bullish trend. So it's a lot easier to understand, I think. And it's also the most effective way to use Ichimoku. So this combined with our TDI, you can see it's quite effective. So it tells you the trend from the Ichimoku cloud, and then from TDI, it tells you where potential reversals might occur. Okay, any questions? No, okay. If not, we can look at some charts. Um, okay, I'm just gonna do an analysis on the current chart that I'm looking at, which is WTI. Okay, since today's session is on TDI, I'll maybe just focus on that. Actually, no, okay, we'll go through the entire process as per usual, and then we'll just use TDI as my Zoom just crashed. Okay, hi everyone. Apologies for that. My computer just crashed on me. Okay, let me just share my screen. Okay, I'll maybe switch off my camera just in case it happens again. Okay, so like I mentioned earlier, I'm gonna just go through the entire process of how we would go about using this. You guys can hear me, right? Yeah, I think it's okay. Okay, so here you can see that price is moving in a quite obvious downtrend. Okay, I'm gonna go in and place my first resistance maybe over here in line with all of the swing lows. And my first resistance up here. Okay. Next, because there aren't any lower levels here that I can see, so I'm gonna go in with my Fibonacci levels and sorry about that. So I'm gonna use a second support over here in line with the 127 level. Okay, so this is what we call kind of a Nike tick shape. But actually, yeah, I might move that level to here instead. So if you're unfamiliar, we go through this pretty in-depth in our Fibonacci series, but I'll just briefly go through it now. It's basically an inverted Nike tick. This is what it'll look like if it's upright. And we basically look at the levels that are greater than 100, namely 127 and 161. Okay, now I go in with the other levels to support my resistance and support levels. So I can see my 23 lines up with the first resistance. Okay, you can kind of see that 161 also lines up with my second support. This is a projection. So again, we go through this more in depth in the Fibonacci series. Okay, so you can see in my second support, this is already a confluence area, which again, if you're unfamiliar, it's basically it's when two or more Fibonacci levels line up. Okay, here we have two. And prices tend to be attracted to these areas but may not be able to break out of them. Okay, so I'm expecting prices to drop to that second support. Now let's pull out our TDI. Okay, so maybe let's first see if there are any crossover signals that we can identify. So I guess over here, right at this swing high, right? You can see that green line crossing below the red line. So this is a sell signal here. Okay. And you can see subsequently price continued to drop. Recently here as well, we also see this crossover happening here, and then price continued to drop. Okay, so that's the first strategy that we went through in our slides. The next strategy, let's look at maybe possible divergence. Um, mm, okay, I guess over here could be one. So here and here. So you can see price has made lower lows, right? But on our um TDI, it's actually kind of maintained at that same level. Okay, so we could see a bit of a bounce up in our first support area, which won't be surprising because you can see the number of times that price has tested this first support. So you can probably expect price to kind of react a bit of that first support, but ultimately the trend we still expect it to continue pushing downwards. So now we can combine our Ichimoku together with TDI and you can see price moving below the cloud, which supports our bearish analysis. Okay, you can also combine it with some other indicators that you normally like to use. I personally like to look at MACD. So MACD you can see is giving us a very strong bearish signal as well. If you want to look at Bollinger Bands on its own, you can also see prices pushing below that lower band, that bottom band of the Bollinger Band. So that also supports our bearish signal. You can also see on TDI, price is moving in that lower band as well. So also supports our analysis. Um, yeah, we can maybe look at RSI and stochastic as well if you want to look at a more um momentum-based indicators. I like to look at SAR as well, so let's look at that. Okay, it's getting a bit messy. Okay, so on SAR, you can see prices moving below the dotted lines. So that's also a trend indicator, and that also gives us a bearish signal. So that supports our analysis as well. I wouldn't use RSI together with this indicator because TDI already comprises of RSI. So I'm going to remove that. But of course, you can look at it as well. Okay, and like what we saw on the TDI with stochastic, we are seeing this hidden support level as well. Okay, so we could see a bit of resistance at our first support, but ultimately, I think there should be enough downward pressure to push prices towards our second support. But if you want to be safe, you can wait for price to actually break out of that first support before going in for a sell towards that area. Okay, any questions? No, all good. So, yeah, you can use the default settings on TradingView, or you can look up a couple of suggested inputs that you can try. Again, these inputs depend on your trading strategy, so feel free to play around with it and see what works for you. Uh, you can play around with the colors of your lines as well. Like I mentioned, sometimes the middle line is blue. Um, yeah, here it's orange, but basically that line tells us the NBL, which is the market baseline, and it shows us the overall market sentiment. So if we look at, yeah, I'm going to remove some of these because it's a bit messy. So if we look at it now, you can see the orange line is sloping downwards, which supports our bearish analysis. Yeah, so I think what will make using this indicator easier is if you just break it down into the different components that it is. So if you want to look at the crossover strategy, just focus on the green and red lines. Just looking at market trend, then just look at the middle orange line. Um, yeah, if you want to look at potential reversals, you can look at any crossovers, um, any divergences, or if prices are moving in this oversold regions, like up here. If it crosses above, that's definitely an overbought signal, which could signal price reversals, like we see here. Okay, and the subsequent price dropping downwards. Okay, so yeah, just basically break it down into the different parts, so that it's not so scary looking. Okay. Um, if there are no other questions, that's all I have for you guys for today. Thank you guys so much for joining me. I hope you guys found this session helpful. Have a great rest of your week, and I will see you guys again next week. Thanks, everyone. Bye. Thanks, guys. See you guys next week.